Hello there. Investors in traditional index funds are effectively investing in the entire market. They're trying to capture market returns, sometimes known as beta or beta. But there's plenty of academic evidence to show that by exposing their portfolios to specific risk factors, investors can and do beat the market over the long term. A world-renowned authority on so-called factor investing is Larry Swedroe.
Factors are nothing more than a characteristic, a trait, or a style of investing that can be expressed even across asset classes. So you could buy value, which is buying what's cheap, in stocks, bonds, commodities, or even currencies. The problem for investors today is in the academic literature, over 600 factors have been discovered. So many that John Cochrane called it a zoo of factors. So how is an investor to know which of the 600 are worth investing in?
In this book, co-written with Andrew Birkin, called Your Complete Guide to Factor-Based Investing, Larry Swedroe identifies the most important factors. The authors set out different criteria. Factors needed to be robust and persistent over time, for example. They also had to be pervasive across different geographical regions. Swedroe and Birkin actually found that just 8 factors met all the relevant criteria.
The ones that we looked at that pass all of our criteria, and we present the evidence from the academic literature, we cite 106 papers, are the market beta, obviously, size, meaning the small cap stocks outperform over the long term, value, momentum, profitability and quality, something that's called the carry trade, and last is the term premium, and we throw out the rest.
This is a big and complex subject which you don't need to understand in any great detail. Suffice it to say that the 2 main equity risk factors are size and value. Certainly size and value funds have become increasingly popular. But is that a problem for factor investors? In other words, do the premiums start to disappear as more and more people choose to gain exposure to them?
There's actually pretty good literature now on this, that for the factors that have been identified, many of them do disappear, but on average they shrink about 1/3. So money does come in, and if you buy the cheap stocks, you push their prices up, you push down by shorting or avoiding the overvalued stocks, if you will, the spread between them narrows, and then the premium obviously would shrink.
One final word of caution. Yes, factors such as size and value do tend to outperform over the long term, but investors can go for many years without seeing the value over and above traditional indexing. So you need to be patient. Thanks for watching. Goodbye.